this fair value measurement in consolidation. Now that's something which you will always have to apply this concept whenever you do consolidation question, whether you are doing a consolidated balance sheet or you're doing income statement. This fair value measurement thing, it will always be involved somehow. Fair value measurement, what does happen? Let me tell you from the beginning. You've got here parent, and you have got here some subsidiary, and definitely you've got different. They tell you the share capital and the retained earnings of subsidiary or etc. And you find out the net assets. Let's suppose I'm just writing down here share capital, and I will write down here retained earnings. So what happens that usually when you calculate your goodwill, you are seeing that how much is the share capital of subsidiary, let's suppose 20,000. How much is the retained earning of the subsidiary, let's suppose 10,000. And you call this thing as the net assets. You call this thing, and I'm considering it at the date of acquisition. Let's suppose that it is at acquisition. Usually in questions, it is not given like this, but I'm just supposing that at the date of acquisition, the subsidiary had net assets of $30,000. And naturally speaking, in the balance sheet, when you make down the net assets, the other side balancing figure are the total assets. So then they tell you, now they tell you that there is a difference in the fair value. There's a difference in the fair value of property, plant, and equipment amounting to, say, I don't know, $3,000 on subsidiary financial statements. Now, what happens that it is possible that the subsidiary is showing its non-current assets with cost model, like the net book value model, whereas the parent has a policy of measuring at the fair value. It is very normal. Parent is measuring the assets at fair value. Subsidiary has all the right to measure at cost model. So subsidiary is doing it, or S company is doing it at cost model. So when parent will acquire this company, they will run a fair value test. They will see what are the fair value of these assets, and they will find out that the fair value, there is some property, plant, and equipment, which on the balance sheet maybe is shown as, let's suppose 7,000. Let's suppose is shown as 7,000. Shown at 7,000. Let me delete this thing. But the market value, suppose that the market value is 10,000. So it means that there is a revaluation surplus which is happening. There's a revaluation gain which is happening, but you would call it a fair value adjustment. Because subsidiary is showing at the net book value, you will show it at the parent is showing at the fair value. So they need to make this adjustment. So we know that there is something which is called fair value adjustment, which we will need to make of $3,000. And this will not, we will not force the subsidiary to change its non-current assets. We don't force the subsidiary to include this 3,000 in its financial statements. We do not. Let subsidiary do their accounting, because their accounting policy is cost model. So they keep on continuing with cost model. But in the group financial statements, we need to account for this 3,000. This 3,000 fair value will make several changes. Number one, it will affect your goodwill. And it will reduce the goodwill as the net assets of subsidiary will increase, because whatever the net assets of subsidiary were at the time of acquisition, they actually were 3,000 less. So when you are doing fair value adjustment, you essentially are increasing the net assets of the subsidiary. And you remember that goodwill is consideration paid minus net assets. So when net assets of subsidiary will increase at the date of acquisition, the goodwill will go down. So this is the first effect of fair value. Second effect of fair value will happen on group non-current assets. You had group non-current assets. Usually you say parents assets plus subsidiaries assets. And here you should say plus fair value adjustment. This 3,000 should also be added here on the group non-current assets. Okay. But before I make this adjustment, let's make another adjustment. Let's keep it at the third place. Let's introduce something else on the second place. On the second place, there will be an adjustment to subsidiary retained earnings. Subsidiaries retained earnings will change. And in fact, retained earning of subsidiary will decrease due to extra depreciation. Because subsidiary actually was depreciating the asset at 7,000, you believe that the asset is 10,000. So subsidiary was charging depreciation or calculating depreciation on 7,000, a smaller amount. The group will calculate the depreciation on 10,000, which will be a bigger amount, and a bigger amount will mean a lower depreciation. So you will always see that this asset, which has the fair value, what is the life? So let's suppose they tell you that the life of this asset is 5 years. So it means that what you are going to do, you are going to say that 3,000 is the depreciation, is the fair value divided by 5 years. So it will be like 600. So by 600, you should decrease the subsidiary retained earnings. We always calculated adjusted profit or adjusted retained earning of subsidiary. And in that adjustment, you have to subtract the 600 number. The 600 number should be subtracted. But you should also pay attention that maybe the acquisition has happened only 6 months before. If it happened 6 months ago, then you should multiply by 6 divided by 12, because you have to charge 6 months depreciation. Or maybe it is possible that acquisition, it happened 2 years ago. If it happened 2 years ago, then you have to multiply with 2. So that you charge not 600, but 1,200 depreciation to the retained earnings. So it will depend on the period of your acquisition. In any case, what I'm saying that you have to calculate depreciation according to the post-acquisition period. I'm using the word post-acquisition period. And post-acquisition period, maybe 1 year, maybe less than 1 year, maybe more than 1 year, you need to make adjustment for that. And then let's suppose it is only for 1 year. So we will say that for 1 year, we will decrease the profit with 600. And then in the group non-current assets, you would be saying parent non-current asset plus subsidiary non-current asset plus this 3,000 and minus this 600. This depreciation which you have calculated, it should decrease the non-current asset, because 3,000 was the fair value adjustment at the time of acquisition. After acquisition, this 3,000 will not remain 3,000. It will be depreciated amount, because that particular asset has lost some value. So you decrease it there. This is what usually comes in F7. There is also a possibility, which actually I don't see it in F7, that it also has tax implication. And in fact, it will have deferred tax implication, because you remember that deferred tax, it arises as a result of changing the book values. So whenever you make change in the book value, deferred tax comes in because you made some gain or you are charging extra depreciation. So it will have tax or deferred tax implications, but usually it does not come in F7. So what you should be remembering for F7 are these three adjustments. Whenever there is a fair value, you remember that where do you make change? With the amount of fair value, the goodwill will decrease. Then you charge or then you calculate extra depreciation and reduce or decrease the retained earnings of subsidiary, not parent, subsidiary. And last of all, when you make consolidated assets in your consolidated balance sheet, you should add this fair value adjustment and subtract the depreciation, take the net amount. This is about fair value adjustment. It is not possible that they give you a consolidation question and there is no fair value adjustment. Fair value adjustment will always be there.